Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is November 13th, 2024. If you did not catch my segment yesterday, Tuesday, November 12th, you might want to do that. It's on gold and silver. If you have an interest in that, it's very educational. And also, I wanted to comment on the market. The market, as I'm going to show you, has done very well. Every person that I listen to says it's a post-election bounce or rocket or whatever you want to call it. Following the election, see, going up to the election was positive. There was uncertainty about who's going to win. And uncertainty usually doesn't do well for the market, but I think the people I'm listening to, I think they're trying to be nonpartisan about it. They're saying, a Trump win was positive for the equity markets. It has not been as positive, by the way, for the fixed income market, the bond market. But the equity markets just took off following his election. Once that was known, they've been on a tear, and they are kind of not looking back. I think they seem to be very resilient. So anyway, just comment on that, and it'll take a little time for it to sort itself out. But politics usually doesn't play into the equity markets very much. But this time it did. So that could change. Usually equity markets are driven more by earnings and forecasts and interest rates and so forth. But so we'll see where this goes in the future. But right now, equities are at an all-time high. They were already at an all-time high, and then they have jumped ahead by quite a bit and pushing them into even a higher all-time high. So, but that doesn't mean they're going to stop. They could keep going. But I would say that when you get valuations as high as they are now, even though there's a reason for them going up, usually, let's say it's policies, economic policy. When they come down, and one day there will be a correction, or maybe even one day there will be a crash. Whenever that happens, the further they go up, the further down they're going to fall. So I'm not predicting that. I'm just saying that when you get into the nosebleed category in pricing, it creates higher level of risk. Okay, so let's get into the dashboard. This is this past week. So this covers the week that I just mentioned. The election was on the 5th, so that was Tuesday of this past week. In the yellow box are the increase in value of the equity indexes, S&P, NASDAQ 100, Russell 2000, IWM, the Dow, and then the foreign markets. Foreign markets were almost unchanged. So the U.S. market took off, but not the foreign markets. Either the emerging or the developed markets did not respond to the U.S. election like the U.S. markets did. Bonds actually went up. They'd been falling for like the last month, and they went up 1.8%. Year to date, we've got, the Dow, the S&P and the NASDAQ, both up over 25%. And then, Russell 2000 and Dow up 18 and 16, and much less for the foreign markets. And then TLT, the 20-year government bond, down 6% for the year. And this kind of makes the case for in a 60-40 portfolio, buy and hold portfolio, you got a variety of equity stocks or indexes, and then you have bonds. And bonds usually in a diversified portfolio is going to have corporate bonds, long-term, intermediate term, etc., government bonds. But bonds are in general are putting a drag on, as they typically do, putting a drag on buy and hold portfolios. It's not making the portfolio negative in most cases. However, it definitely puts a drag on it. And those people who are bought into that, they may see the anemic growth of their portfolios. And maybe that's frustrating to some people. It would be to me. I don't believe in buy and hold portfolios. I don't believe in 60-40. I don't buy bonds. So, that's my bias. And this is an example of why I don't do that. Okay. These are the sectors within the S&P 500. There are 11 industry sectors. What's interesting about this, when you look at this is why equities are, in my opinion, a better way to go. Warren Buffett does not buy bonds. Yale and Notre Dame, which have the top two performing, or they're in the top five. I think they're the top two performing endowment funds in the country. For a performance standpoint over a long period of time, they don't buy bonds. I think they buy some I bonds, but other than that, they don't buy the traditional bonds. So what's interesting is that, the average financial advisor is recommending bonds, but the wealthy are typically, most of the time, they're not buying bonds. It's just terrible investment. So the yellow box shows last week, all 11 industry sectors are positive. Wow, that's amazing. From, let's see, the high was consumer discretionary up 7%, and the low was consumer staples at a little less than 1%. The rest are somewhere in the middle. On a year-to-date basis, the financials are 30% gain for the year. And industrials, number 2, that's interesting. Technology, right close to it, and so forth, all the way down. The worst sectors are retail and real estate, and those are both up 9%. Okay, this is the 30-month chart over the last 2-year period of time. It's a line chart. One move equals 1 week. And you can see from the low in October of 22 to present, I drew a black arrow so you can see the direction, the trajectory of the market, and pretty much it has stayed above the 20-period moving average. At the very end, the very far right, the move up, upper right corner, you can see that move up there. That shows the increase for this past week. This is the same period of time for the S&P 500 using SPY as the ETF, going from the bottom up to the top, done on a candlestick chart. And you can see, if you look at the very far right of the chart, you can see that hollow candlestick, which represents, it means that when it started here and it ended up here, and it engulfed the red candlestick next to it. That's a very bullish indicator. So it looks to me that going forward, at least for the time being, that it is positive, the market is positive for equities. This is a relative strength chart putting the NASDAQ 100 as the numerator and the S&P 500 as denominator. So when it goes up, it favors the NASDAQ 100, and when it goes down, it favors the S&P 500. So generally speaking, over the last, since the beginning of 23, so that's, about 22 months, it's moved in an upward direction. But it has, in the last few months, had a pullback, and now that it looks like it's strengthening and wanting to go back up again. So that's the relative strength. And relative strength on growth and value. The growth ETF within the S&P 500, S&P stocks only, is SPY-G. As the numerator divided by SPY-V, the value stocks. So when it goes up, it's favoring growth stocks. when it's going down, it's favoring value stocks. And you can see it's gone up and down, but this past week, like what we've just seen, is it's up, it's favoring growth stocks. S&P 500 compared to small cap. Now, I didn't dwell on this when I was covering the indexes in the first slide, but the largest growth index was the small cap Russell 2000 ETF, IWM. They both went up. The S&P went up and the small cap IWM went up. But look at, and I think this is a 2-week period, look at that drop at the far right of the chart. That shows you that small cap is coming back into favor. Again, that's a bullish indicator for the market in general. So again, relative strength. Both went up, small cap went up greater. Okay, long-term government bond. We saw initially, again, that first chart I showed you, the TLT had an increase, I think it was 1.8%, and for the week. And you can see at the very far right, the lower right corner, where the TLT comes down over that 5-year period of time, the little tick up at the very end, that represents that 1.8%. So in general, it's declining, but for the week, it was positive. The dollar of the winners last week, and actually for the last month or so, one of the winners is consistently been the dollar. The dollar is up. This is a 4-year chart, so you can see from lower left to upper right what's happened, but you can also look at that sharp line up that's several weeks up at the end, showing the strength of the dollar. So if you're buying things or spending money traveling in foreign countries, most countries, the dollar is going to be very strong. It'll go further in other economies. But if those people are investing or spending money here, it will have a diminished value. They will have to spend more dollars, more of their currency, to get goods and services in our economy. Gold has been moving up consistently, but this past week it had a little bit of a pullback. You can see that at the upper right chart. Still, the trend line has not been broken, and I think it looks to me like it's taking a breath and will continue its trajectory upward. I don't know that. That's just an opinion. Silver, even more so, had a pullback and still trending upward, but not as consistent as gold. Bitcoin, again, moving up. It had a very good week, and as I'm speaking today is actually being recorded on Monday. It'll be published on Wednesday. But as I'm speaking, it's up a lot. This morning I looked, and I think it was up 10%. So a big move for Bitcoin. And again, that was due to the election. Trump was touting Bitcoin, and I won't go into the policy proposals he was suggesting, but that was good for the price of Bitcoin. Volatility, as the market goes up, the volatility index, the VIX, the VIX, measure of volatility, usually downward volatility or downward price movement of equities, the volatility index moved down. So no surprise there. And then I put my marker up there at 24 so you could see where it is relative to where I think risk begins to increase significantly. This is interesting because last week when I showed you this, I believe it was all 6, maybe it was 5 out of 6, but I think it was all 6 were negative. And if it wasn't all 6, for the last month or so, it's been quite negative. All indicators moved positive. And 5 of the 6 moved positive the day after the election on November 6th. And 1 of them moved positive on the day of the election. Okay, cross-asset relative performance. comparing one asset to another for the last week, the last month, the last quarter. So going from left to right in the columns. Stocks stronger than bonds. High beta, high volatility, is stronger than low beta, low volatility. Small cap, stronger than the broad market, the S&P 500, and stronger than generally large cap stocks in general. Technology, stronger than the broad market, the S&P. Growth, stronger than value. U.S., stronger than developed markets and emerging markets. On the bonds, corporate bonds are stronger than government bonds. Last week, last month, last quarter. Now this is an interesting chart. I bet you haven't seen one like this for a while. The U.S. stock market, let's just use SPY, it's represented by SPY, is stronger than every country listed here and every region listed here, with the exception of China, which was stronger the last quarter. But in every other country, there's 25 countries and regions, the U.S. is stronger the last week and the last month, and 24 out of 25 are stronger for the last quarter. Very interesting. This just gives you an indication. Now, I'm showing this, U.S. versus South Korea. I'm showing this because the relationship between the U.S. and South Korea has consistently favored the U.S. SPY since the beginning in January of 2023. So about 22 months, just the consistency of it caused me to show. But if you said, you know what, I could pull up various countries here, and the end of the chart to the right would look similar. It's very strong. But with Korea, I don't know why, but it's a weaker, it has been for this period of time, a weaker equity market than the U.S. Gold and silver. Gold was down slightly, 1.8% for the week. As I said, it looked to me like it's a correction. I don't know that for sure, but it looked like that. The price is $26.87 spot price. Spot price on silver is $31.32 before the markup. And silver declined 3.5%. Again, from the previous chart on SLV, silver, you saw a deeper decline than on gold. And these are all measured from last Friday to the previous Friday. The gold-silver ratio is 83-1, gold numerator, silver denominator. A monster box of silver dropped because the price of silver dropped some. So that's 60, as of Friday, was 16,310. And the markup, I'm using a markup of $1.30 for my illustration, bringing the cost per round, per ounce on silver to $32.62. And my son Preston is a precious metal dealer, and I got these prices from him. Okay, a good report. So if you're invested in equities, you're probably happy. Equities and bonds, not as much, but you're probably still happy. So glad to give a positive report. If you have questions or comments, leave them in the comment section below.